with that being said, Rick, I'm going to turn it over to you. Again, I appreciate you taking the time to follow back up with us, our students, other team members that are on this call, and the people that will be watching this in the future as well. So thank you.
It's an honor to be here, man. Like I said, I love working with you guys, and we have a lot of synergy and long-term stuff going on. So so for you guys, obviously, if you've watched this before, I'm not going to go too much in depth on each and every one of the slides. In fact, I'd like for this to be a little bit more interactive with John and I and you guys even. There are a lot of changes since even the last conversation. I feel like with this coronavirus, things change almost by the hour in some instances. And so what I'm going to do is share some stuff to give you perspective, and then we're going to dive into some things. And then towards the end, or whenever you guys want, we'll start going into a couple of markets that some of you guys requested we analyze. So we want to show you some of that and give you perspective. So with that said, as John said, I am a real estate investor first, and we also do private lending. It's one of the businesses that we have. We are literally in the moment getting the final stages so that our third fund will be active. That fund we're excited about because it does a little bit of everything. In fact, it'll be funding projects and partnerships with John, doing commercial, residential, and the best thing, it's a Reg A offering. So for those that don't know what that means, basically that gives us the ability to raise capital from both accredited and non-accredited investors, and people can jump in with as little as $5,000 and be a part of these $1 million deals we're doing. So super excited about that. That's on the way. So now, past my shameless plug, let's talk a little bit more about kind of what's going on. And so what a lot of people come to me and they start asking a lot of questions about what's going on in the market, and especially when the coronavirus hit, the first thing that I wanted to do was to go back into history and say, is there anywhere that we can learn from the past to really gain perspective on how to deal with the future and where we're at right now? And so we immediately got on the phone with our economist, and I mean, he's blowing my mind right now with more data that we're looking at. But what I want to show you is, in doing the research, and this is a visual I want to show you, what you're looking at in this screen right now is literally a visual of, I'm going to try to move this here so you can see it, of some of the historical data that we have found of economic corrections. This doesn't necessarily mean pandemics, but what I want you to see is that if you look at real estate and if we look at the markets over time, what you're going to find is that historically there are always cycles. There are always going to be cycles. There's going to be times where we have good times, and there's going to be times where we have droughts and bad times. And so the reason I want to give you perspective is let's go back in history for just a minute. The very first correction in history that we found was in 1797. And I don't want to go into too much detail on all the history. The next one was 1857. 1873, believe it or not, was actually considered the Great Recession, which, funny enough, it wasn't changed till 1929, where they called it the Long Recession. So this was a major economic failure where banks failed, you name it, a variety of things happened, from financing a lot of shaky railroad transactions from speculation. So now we go into 1893, 1907. So I think you guys are getting the gist of the fact that history is showing us a pattern of corrections over the years, most of which have to do with debt. So I'll just leave that there for a minute. Then we go to 1918, and this is for a minute where I want to pause. The reason why this is important, and later on we'll talk a little bit more about this, is because during 1918, there was a massive market correction, which literally was followed by the end of World War I. But what made this particular situation a little bit more interesting was the fact that not only was there an economic collapse, but there was a pandemic, which, funny enough, it's not funny really, but literally the people that, if you look at the actual kill rate, if you will, on the coronavirus versus this scenario, it pales in comparison. So the pandemic that took place in 1918 literally came from the actual, it was a flu, the very first flu, from some of the soldiers that came back from World War I. That pandemic spread, which was called the influenza virus. It affected over 500 million people. And literally at that time, that was a third of the world's population. And that also represented about, I want to say it was a total of 50 million people that passed away. So just to give you perspective, that's a massive number of people that died. Now, the reason why I wanted to highlight this, because we're going to talk about that a little bit more, but guess what happened after this got under control? The market grew. Things started growing again. And then yet again, a decade later, in 1929, then we have the Great Recession. Now we'll fast forward. You'll keep seeing the trend, 1945, 1949, 1953. Now we fast forward to 2001. 2001, yes, was another correction, But this one got hit 3 times, and it started with the tech bubble. It then followed by 9/11, which we had an actual terrorist attack that nobody even accounted for. And then by 2003, the SARS outbreak takes place. That created an economic correction. Once again, here we're dealing with a pandemic. Luckily, it didn't spread nearly as much. It only affected over 8,000 people, and we were able to take control of it. But the reason why I'm giving you guys this information is I don't want to give you a whole history lesson. I want to give you perspective. And the most important thing I want you to see is, even though, yes, we're going through very tough times, this too will pass. And so the most important thing for us to understand is that if we know that in mind, then we can start positioning ourselves to survive here and reposition ourselves to thrive, so that when the market picks back up, we're the ones on top. We're not the ones in bankruptcy, okay? So now if we go here to, we have 2008, one of the worst housing crises, and now we have 2020. This is the coronavirus. This is the only pandemic or the only economic recession that we have seen in our history that was only caused by our own self-afflicted stopping of doing business. And so that's really one of the things. And John, I don't know if you want to chime in on this, but I just wanted to give people a picture, first of all, of the history of what's going on, and that we have so many things to learn from these particular 2 corrections that we're going to use a little bit later today as we talk about it.
Yeah, it's definitely interesting. I think for a lot of people, that if you look at this, and one thing I do want to touch on that you were talking about is, just like all of us could remember 2008, and it's kind of a gut check. A lot of people just did not want to invest after those. That's a time where I went heavy in the market, 2009, 10, 11, 12. I mean, I kind of look what everybody else is doing and do the opposite, right? If everybody's getting out, this will pass and the market will pick back up. A lot of people say, well, gosh, I wish I would have invested back in 2009, 10, 11.
Mm-hmm.
We already know, we'll see some adjustment here. And when we're down, should you be investing? Absolutely, you should.
Yeah, this is definitely the time.
Yeah, for 100%. So the other thing that you just touched on is, you said self-inflicted. Yes. So this will be interesting to see, there's a lot of money trying to build, make sure that we stabilize here, and it will be interesting to see how we pull out of this. But you're right. It's not, I touch base with people on the secondary market all the time. Do they see anything? What's going on? Everything seems so good. There was no indicators of anything that was going to happen, something you couldn't predict. And so it's ultimately what's happened here. Other than that, the economy was strong. So, I think everybody knows what we're going to have to do is see how quickly we could get, the country back open and get people back to work.
Exactly. And actually, John, this really opens up a quick point that I think we can make briefly here. I was trying to share this screen because I think it'll go perfectly with kind of what we're talking about here. So what John just mentioned, guys, and this is part of the content that we covered, but what I wanted to share in perspective was the pre-pandemic fundamentals of our market. Because, this is super important for us to understand. These graphs are going to give you a picture from 2007, which was prior to the correction of 2008. And it's going to give you February, which is right before all hell broke loose, if you will, with the coronavirus. So if you look at the U.S. bank reserves, in 2007, the banks had over $44 billion in reserves prior to the correction. Look at February. It's a record number. We had over $1.7 trillion in bank reserves prior to. So our economy was booming with regards to the U.S. banks having reserves to be able to grow and expand the lending and the banking system. Look at corporate profits. In 2007, right before that crash, they were okay in comparison to, but look at where we are now. So again, we were hitting record earnings and profits for corporations. And then the other piece that's important to look at is how much money did these companies have in hand? And if you look at 2007 in comparison to where we are now, it's insane, the amount of cash in hand. And so the core fundamentals of corporate profits, bank reserves, and corporate cash in hand was literally at a record time. So we literally had an economy that was starting to roar and going in the growth stage, and then we get hit by this pandemic. So while we don't really have a lot of perspective with regards to how long this correction will take, the reality is we can say that with certainty, this was not caused by some core or bad fundamentals in our economy. So now it's all about just trying to figure out how do we position ourselves and how do corporations begin to reposition themselves to survive and begin to thrive as the market comes back and the government opens up our marketplace. And so I just think it's important for us to really visualize that information, because it is important for us to understand that this too will pass, but we had some really good fundamentals in this economy. It was really solid. Our unemployment rates were at literally record lows. We had strong low mortgage rates. All those core fundamentals were truly, they were there. It's just unfortunate that with this circumstance, we have to go through this pestilence.